Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Neurocrine Biosciences Inc. annual report. Neurocrine Biosciences Inc. is a pharmaceutical company that specializes in developing treatments for various neurological, neuroendocrine, and neuropsychiatric disorders. The company's product portfolio includes several medications that have been approved by regulatory authorities. The company's products can be broadly categorized into two groups: those already on the market and those still in clinical development. On the market are INGREZZA, ALKINDI, Efmedy capsules, Orilissa tablets, Orion capsules, and CRNESSITY, which treat conditions such as tardive dyskinesia, adrenal insufficiency, congenital adrenal hyperplasia, endometriosis, uterine fibroids, and classic congenital adrenal hyperplasia. In addition to these approved products, Neurocrine Biosciences is also developing several promising candidates in clinical trials. These include valbenazine for dyskinetic cerebral palsy and schizophrenia, NB-1076986 for movement disorders, osavampator for major depressive disorder, NB-1017568 for schizophrenia, and NB-1070770 for major depressive disorder. The company has also established partnerships with several leading pharmaceutical companies, including Enzira Pharma UK Limited, Takeda Pharmaceutical Company Limited, Xenon Pharmaceuticals Inc., Voyager Therapeutics Inc., Mitsubishi Tanabe Pharma Corporation, and AbbVie Inc. These collaborations demonstrate Neurocrine Biosciences' commitment to advancing the development of innovative treatments for complex neurological conditions. Overall, Neurocrine Biosciences is a leading player in the field of neuropharmacology, with a diverse portfolio of products and a strong pipeline of promising candidates in clinical development. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview on what might cause a stock price to increase. The stock price of Neurocrine Biosciences Inc. has increased slightly in the past year due to several factors. One major reason is the company's continued success with its flagship product, elagolix, which has shown promising results in treating endometriosis and uterine fibroids. The FDA approval of this medication has boosted investor confidence, leading to a rise in stock price. Another factor contributing to the increase is the company's expanding pipeline of new products. Neurocrine Biosciences Inc. has been actively developing several innovative treatments for various conditions, including Parkinson's disease and schizophrenia. Positive clinical trial results and partnerships with other pharmaceutical companies have generated excitement among investors, driving up the stock price. Additionally, the company's strong financial performance has also contributed to its increased stock value. Neurocrine Biosciences Inc. has reported steady revenue growth and a significant increase in net income over the past year. This financial stability has reassured investors, leading them to buy more shares and drive up the stock price. Overall, the combination of successful product launches, expanding pipeline, and strong financial performance have all contributed to the slight increase in Neurocrine Biosciences Inc.'s stock price over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company are multifaceted. Government rebates, such as estimated and actual government rebates, can significantly impact revenue. Additionally, sales volume is another crucial factor, with discounts and allowances on sales reducing revenue. Changes in payer mix can also influence revenue, while contractual terms with customers or partners can either boost or hinder revenue growth. Collaboration revenues, including upfront payments, milestone payments, and royalties from collaborations, are essential contributors to revenue growth. The commercialization of new products through joint R&D and commercialization efforts is another key driver of revenue growth. Furthermore, accounts payable and accrued liabilities can indicate potential drivers of revenue growth or decline. Net operating losses and research and development credits also impact tax provisions and potentially affect revenue. Milestone payments and potential future payments from collaborations further contribute to revenue growth. Overall, a company's revenue growth or decline is influenced by a complex interplay of these factors, requiring careful consideration and management to achieve optimal results. The net income of the company experienced a significant increase over the two-year period, rising by 37% from $200 $349.7 million in 2023 to $341.3 million in 2024. This upward trend continued into 2025, with an additional 40% growth, resulting in a net income of $478.6 million. However, despite this substantial increase in net income, the company's profit margins underwent some changes. The operating income margin decreased from 24.2% in 2024 to 21.7% in 2025, indicating a slight decline in operational efficiency. On the other hand, the net income margin showed an improvement, rising from 14.5% in 2024 to 16.8% in 2025. This increase suggests that the company's ability to retain earnings and generate profits has improved over time. The company's operating cash flow has been consistently positive over the past 3 years. In 2025, it reached a high of $782.7 million, indicating strong financial health and ability to generate funds from its core operations. The trend is also evident in 2024 and 2023, where the company generated $595.4 million and $389.9 million respectively. This positive operating cash flow demonstrates the company's capacity to manage its finances effectively and invest in growth opportunities. The company's financial health is a crucial aspect of its overall performance. A review of the company's debt and interest expenses reveals some notable trends. Despite no significant change in the company's debt level, there has been a substantial decrease in interest expenses over the past year. In 2023, the company incurred $3.8 million in interest expenses, but this figure dropped to $1.6 million in 2024. This reduction of approximately $2.2 million represents a significant decline in the company's interest expenses. Such a decrease is likely due to various factors, including refinancing or restructuring debt, changes in market interest rates, or improved financial management. Whatever the reason, this trend suggests that the company has made progress in managing its financial obligations and reducing its costs. The performance of various segments and regions in 2025 was a mixed bag. One notable standout was INGRZZA, which saw a significant increase in net product sales to $2,513,700,000, marking an improvement over the previous year. On the other hand, CRNESSITY emerged as a new segment in 2025, generating $301,200,000 in net product sales. While this is a respectable figure, it pales in comparison to INGRZZA's impressive performance. In contrast, other revenues remained relatively stable across the years, with minimal fluctuations between 2023 and 2024. The slight dip in 2025 was not significant enough to warrant concern, indicating a consistent trend in this segment. The management of this company is optimistic about its outlook, driven by strong revenue growth in 2025, primarily due to the success of its product INGRZZA. The company's focus on expanding its product offerings through a robust research and development pipeline, including new treatments for conditions such as CAH and schizophrenia, suggests a commitment to innovation and growth. The management is also investing in commercial organization to drive growth, with a specific emphasis on expanding formulary access for INGRZZA. This indicates that the company is prioritizing its existing products while also exploring opportunities for expansion. Additionally, the company's share repurchase program demonstrates a confidence in its financial resources, which are expected to be sufficient for at least the next 12 months. However, management is not naive to the risks facing the company. Regulatory changes, compliance costs, cybersecurity threats, and product liability risks are all acknowledged as potential challenges that could impact the business and financial performance. Despite these risks, the overall tone of the summaries suggests a focus on driving growth through strategic investments in research and development, commercialization efforts, and a commitment to innovation. The company's financial strategy is focused on retaining its earnings rather than distributing them to shareholders. According to the provided information, the company has made it clear that it will not be paying out dividends. This decision suggests a preference for investing in the business and driving growth over providing returns to investors through dividend payments. Furthermore, the company has also chosen not to engage in share buybacks. By not repurchasing its own shares, the company is able to maintain a strong cash position and allocate resources towards strategic initiatives that can drive long-term value creation. This approach indicates a commitment to prudence and a focus on sustainable growth over short-term gains. Concerns about inventory buildup and supply chain disruption. There are valid concerns regarding the potential for inventory buildup and supply chain disruption in the pharmaceutical industry. One major concern is the risk of supply chain disruption, which can be caused by various factors such as geopolitical tensions, page 26, dependence on third-party manufacturers and distributors, page 31, tariffs and trade restrictions, page 43, and cyber attacks on supply chains, page 45. These disruptions can have severe consequences for companies, including the loss of significant customers and uncertainty around replacing them. In addition to these concerns, there is also a risk of inventory buildup. For instance, the termination of a license agreement with BIAL resulted in decreased ONG&TYS inventory reserves, page 57, indicating that inventory levels may not be sufficient to meet demand. Furthermore, a company acknowledged having concerns about inventory buildup without specifying any particular reason, page 81. These issues highlight the need for companies to carefully manage their supply chains and inventory levels to mitigate potential risks and ensure business continuity. That concludes the financial summary for Neurocrine Biosciences Inc. Feel free to comment below, and I will be happy to answer them when possible.